If you don't see a recession in your models and you don't have Fed tightening, then I don't think you should be underweight equities, especially not in this world where we have what we call a debasement mindset. And I think that does benefit, broadly speaking, equities. A debt deflation mindset means you're just more worried about losing. In a debasement mindset is you're worried about losing purchasing power. And so I think that's kind of the mindset that comes into society. And then you see it start to manifest in market behavior.
This episode is brought to you by VanEck Semiconductor ETFs. You'll hear more about the VanEck Semiconductor ETF SMH, the largest semiconductor ETF, and its newer VanEck Fabless Semiconductor ETF SMHX later in the show. Let's get into it. Welcome to another episode of Other People's Money. I am joined today by Warren Pies. He's co-founder and strategist at 314 Research. Warren, thank you so much for being here with me today.
Yeah, thank you for having me back on, Max.
You've made a couple of calls recently. One is a bit of a longer term view, sort of your post-COVID big picture view, that we are moving from the market being concerned with deflation to being concerned with debasement. You believe that's still the guiding force of the market over the long run. Can you talk to me about where we were in this deflationary world and where we are today as we're more concerned about debasement?
This kind of goes back to the founding of 314 and coming out of COVID and how we thought that that was the end of an era, really, and that people hadn't recognized it yet, and that this would be a process of recognition, and that process is ongoing. And it's really this move from a deflationary mindset, we call it a debt deflation mindset, to a currency debasement mindset. And the debt deflation mindset dominated markets from, say, 2008 through COVID up to COVID. And that was when we were in this sort of a balance sheet recession. You can lower rates and you can't force any more borrowing out into the private sector. And there's just economic malaise, basically. And there's just a real reticence to do fiscal spending and fiscal stimulus. And that was that '08 to 2020 time period. And the scars of the last crisis, I really do think they reverberate through investor psychology, and it shows up in market patterns, really. And so the big scar that the GFC left was this concern of principal protection. And we could call that debt deflation. And so, your typical recession, your GFC was all about building up a bunch of private sector debts and then deflating them or defaulting on them. And that was a principal losing event for people. And so for investors. And so I felt like that was the mindset. And now we've gone through COVID, and it's basically 5 years post COVID here. And I think that the debasement mindset that we flagged back at that point in time is really taking hold. And the debasement mindset is one where you're less concerned about the absolute nominal loss of principal, and you're more concerned about the loss of purchasing power, of just not keeping up with the rate of appreciation of assets. And so, I think this manifests most obviously in like the housing market and the car market. I've always said the American dream is really like, what is the core of the American dream? I think the core of the American dream is to be able to at least aspire to own your house, put 20% down, 80% mortgage, and afford the payments, have it be like, 30% of your income, 25% of your income, whatever. All that math has to make sense. And the same goes for, if you can't own a car, the first maybe step to ownership society and to a capitalist society is to own an automobile, a nice automobile. Americans love their big cars and trucks. And so I think you see coming out of COVID, everything leveled up in price, 40%, 50%, whatever it is. I mean, in my neighborhood, I live in Florida, so you have the dual forces of basically money printing during COVID, and then all the people moving here to get out of exodus out of say like New York and other blue states to get to Florida. And the real estate in my neighborhood is doubled. And it's just, you realize it's never going back into that trajectory we were on pre-COVID, because we're in this new debasement world. And I think everyone's starting to realize that, they just wake up one day. Yeah, their paycheck looks in nominal terms pretty good. Paycheck nominal growth of income has been pretty good and all that, but it just doesn't go as far. And I know that people talk about eggs, and they talk about the grocery store. You got the guy, the New York City primary winner,
Donnie.
talking about, basically government run grocery stores. Like it I don't think that's what really at the heart of the discontent throughout this country. I think the heart of the discontent is the core of that American dream that I'm laying out. This house and the inability to make the math work on a house and a car. And so that's why you see these pleas for lower interest rates, for lower mortgage rates, from Scott Bessent, from Trump, and from everyone. And it's just this really difficult adjustment period. And so then what does that mean? What does a debasement mindset look like? Well, I think a debt deflation mindset means you're just more worried about losing. In a debasement mindset is you're worried about losing purchasing power. And so how does that manifest? It manifests in sharper, j- re, you know, retail buying dips. They've been conditioned to buy dips. They think this is an opportunity. They've been proven right for a number of years, and the recovery has become more rapid. You're seeing more kind of speculation. It kind of bubbles out into the crypto world. It becomes part of this is the way to make that math work. It's not happening through traditional 9 to 5 jobs. You need to speculate. You need to gamble. You need to try and hit a home run versus a bunch of singles. And I think that's kind of the mindset that comes into society, and then you see it start to manifest in market behavior. This last correction and then rebound, I think, was like a great example of it, because it was, by all accounts, the bottom was set by all accounts by retail investors. And so I think you see that, and you have to make your adjustment as an institutional investor. Our big adjustment over the years has been to add in, to squeeze out. I think in a debasement world, the risks are more likely to emanate from the bond market and less from the economy, and just like a '08 style recession. I mean, for all the reasons that everyone who listens to these macro podcasts understands. You run a big pro-cyclical deficit like we have over these years, and you're jamming money into the private sector. Balance sheets get recapitalized. I mean, this buildup of debt and then deflation that marked the GFC and post GFC fears is just not with us anymore. And so private sector continues to be in a good shape. And so the crisis is more likely emanate from the government side of that equation, of that ledger, whether it's a retrenchment in spending for some political reason or a problem in the bond market. And so those are the things that you have to start worrying more about and analyzing when you're trying to stress test your portfolio or whatever. And I think just thinking about new outlets, because the other point that we made immediately coming out of COVID was this negative stock bond correlation was not going to be with us anymore. So that takes some of the magic out of the 60-40 portfolio. Everyone's talked about this as well. So the logical place where that ends is to have the capacity to go into more real assets in your final, in your multi-asset investment plan. So you need more gold, more Bitcoin. I look at energy as an alternative investment at this point, and managed futures, things like that. You just need to have a broad menu of assets and see which one. And it's a blob of money that's going to flow at different points into different areas. So we break everything up. We break the commodity segment up. We break Bitcoin away from gold. You need to have more than just this broad bucket. You have these specific areas that are where the blob of liquidity is going to flow to at different points in time, and you need to get it into those. When that starts manifesting in the market. So that's the big picture view that we see. And I think it's still ongoing. This mindset shift, I don't know, maybe 50-60% of the population has caught on, but the scars of that GFC are still with us. And it's still, we still have more people to bring along or drag along. And then there's always the problem of the cyclical analysis of things like the bond market. And a lot of people confuse or can get worried about, there's these secular long-term problems in U.S. fiscal situation, and they can't reconcile a cyclical time frame where things are actually okay. And so they also stay on the sidelines too long. So these are the kinds of new challenges that a debasement world presents.
I want to get into those ebbs and flows because with these big secular views, it always oscillates, along a trending line, whether it's up or down. So, where do you think we were cyclically in the first half of this year along that debasement versus deflation ideology?
Our view was that we were in this. Yes, we acknowledge all the things that I just laid out in this debasement world and the fiscal problems that are so often discussed. And I mean, we got the big, beautiful bill going through right now, and everyone's trying to figure out what that means. But yeah, I mean, I think we have it's pro-cyclical deficits. And what does that mean? I think it means a higher base level of inflation over the long term. But coming into this year, I thought we were in this nice cyclical period where inflation would be very calm. There'd be disinflation across the main vectors. So we talk about uh, housing. We saw a lot of disinflation in the pipeline that's come through. Talk about oil. We saw disinflation in the pipeline, and that has come through. Weak oil prices, and then the labor market as well was. We didn't see the labor market tightening in a meaningful way that would cause inflationary pressures there. So we thought we'd have a period of cyclical disinflation, sorry, and in this secular period of higher inflation, which would be actually a very nice environment for the stock market. So we're pretty bullish on the stock market coming into the year. Our big concern was that sentiment. There are too many people with us on that trade, and they were late to the party. If you were bullish in 23 and bullish in 24, you started to see strategists and other people who had been bearish flip bullish coming into 2025. It was they had to get back in line. You can't do 3 straight years of being bearish when the market goes up that much. And so our view is that you needed to have something to shake that sentiment out in order to have the kind of year we expected. And that was a first half correction of at least 10%, what we called for. We got it. It's tariff induced. We still think there's like a growth scare that's bubbling under the surface as well. And that's still kind of coming through. We had the negative ADP print today, and that could be part of that coming in. And so ultimately, I think the Fed ends up getting back. The tariff thing kind of derailed some of these, but we're back on track for the Fed to start cutting again multiple times this year. And I think like going back to the big concern was that we don't see a problem in the near term in the bond market. So that should give the green light to equities to continue to perform.
So you don't think the big beautiful bill has a potential to spook the bond market, or that already happened? We're past that.
I don't think that the bond market was ever all that spooked, to be honest. I think there was a big narrative around that. Everyone is because what I'm saying is not entirely groundbreaking. And we've been saying this for years, and I don't think it's a groundbreaking thing to say this. It's just how we frame it, from deflation to debasement. If you listen to any macro podcast, it's some variation of this mostly. And some people are in the more like the world hasn't changed much, and I'm open to see how things go. But it's it's more about, so people are really tuned into that as a risk, the bond blow up. So, but I think they're seeing shadows. I think they saw shadows last year. Fed cut rates when in September and then through the end of the year, and the 10-year rose, and you had a whole bunch of bond bears come out and say, "Oh my gosh, this is a Fed mistake." Some really dramatic language around that move. And really what we saw and what we said at the time and what I think has proven out now is that the curve was just the long end of the curve was like by the 10-year, for example, was just so way overvalued. It had priced so many cuts in already. And then when the Fed came in and supported the market and the data came in, it wasn't quite as bad as it was priced. That you had to get this normalization of the curve. So we had this bear steepening in the yield curve, which a lot of people struggled to interpret correctly. They saw it as the bond market throwing this kind of panic or throwing a fit and maybe responding to fiscal prophecy. And there was a little bit of that, and there's a little bit of the tariff stuff, and there's like this big fear that we're going to reverse all these flows, but the tick data doesn't show that. And I think it was mostly just noise. The yield was, the 10-year went down sub 4%. It shot back up. I don't think it was some big. I think there was just a lot of volatility as we sorted through some very volatile policy times. But I don't think of it as like everyone's call the most common phrase you heard was, "Is this a Liz Truss moment for the United States?" and things like that going through. And I just don't think that we've had that yet, you know? Maybe we get that one day, but we haven't had that yet, you know? And, that's really about, you know, can the market digest the supply? Will the foreigners keep buying the bonds? And those are very slow moving factors. The market took down quite a bit of coupon supply last year, despite the fact that everybody is really like wound up over the forward outlook for supply. With QT winding down more or less this year, the um, the funding gap actually gets smaller going through the end of this year and into next year. And there's another factor of how much tariff revenue we pull in on the big beautiful bill and how much that affects the ultimate funding gap, the deficit, what you want to call it, whatever you want to call it. And so yeah, I think our view is that it hasn't negatively impacted the bond market. And I don't see that the bill in its current shape uh causing an imminent move. I don't think that's what yields are moving off of right at this moment.
Breakthroughs begin with semiconductors. With over 23 billion in assets under management, the VanEck Semiconductor ETF SMH is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack, from design to manufacturing. Historically, this unique construction and methodology have helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHmax to learn more. Using a similar philosophy, the VanEck Fabless Semiconductor ETF, SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHXmax to learn more. And now back to the interview. I feel like there were two narratives. There was the fiscal profligacy, and then there's also the sort of just anti-Americanism as a response to the tariffs. I think both probably would have showed up in the tick data, but specifically people were talking about foreigners dumping US treasuries. Did that show up in the data at all?
No, my recollection is especially because we looked mostly at Asia and in Europe, and Asia and Europe were net buyers in April. The data we have is for April, and so we saw net buyers for foreigners, and we haven't had a lot of foreign buying of bonds for of treasuries for a while. I think there is if you get into the data, they were buying the treasury data. They were buying more short term debt, not long term debt, and of course the fear is on the what's going to happen. The long term debt side. In recent days, we've had Trump and Bessent saying, "Well, we're not going to issue long term debt while while Powell's at the Fed and starve the market of coupon supply and all this and that." I think that, and then you see so many people overreact to that. Like it is a wildly inappropriate statement from Trump to get involved in this stuff. Like, don't get me wrong, but he talks so much crap. At this point, you have to kind of like look through it. What I think Bessent's going to do is just keep coupon issuance steady from where it's been. He continued the Yellen framework. I think he's going to keep going with that. And I think that's when they say they'll not issue any more coupons, but I think they're just saying we're not going to ramp up our coupon issuance until we think it's a better point in the cycle. And that's probably a little bit off at least into next year. You know, Powell's there at least for another year or so, a
So
little less.
more in relation to the prior statements about how they wanted to term out the debt. That's just not a right now thing.
I don't know if they're ever going to term out the debt, to be honest. I just don't think it's probably going to happen. I mean, it's just like, why? And, you know, what is the split between bills and coupons right now? It's something like 22% of debt outstanding is bills right now in 22, 23. And the target is to get it to 20%, right? And so we've crept above the target. But QT's over. You know, I think that if I remember, we broke it all down last year. If I recall, the like last year, the funding gap was a 2.5 trillion funding gap with the United States. So part of that, let's say, call it a $1.8 trillion deficit, and then 700-ish billion in quantitative tightening that created a part of the gap for the Treasury to fill. And so as QT goes away, that even if the deficit rises by some degree, let's say that funding gap goes to 2 or 2.1 trillion. Well, last year I think the Treasury did 1.75 trillion of coupon issuance. And if they do that again, 1.75, 1.8 trillion of coupon issuance, then you're right back in line with that 20% bill to coupon split that everyone's so wound up about. So I just don't see the crisis yet. I think it's just like everyone wants to jump to the end of the book. You can see out in front of us that these things are unsustainable, that these trends are unsustainable, but that doesn't mean that tomorrow is not going to, the sun's not going to rise, in markets. And so I think there's a lot of that, this getting your time rate frames confused. And so when I look at it, I don't see an imminent crisis in the bond market where we stand today.
How do you think predictions around, the Fed's next move is affecting the bond market right now?
I think that's a big part of our framework for like what is fair value on the 10-year. Like where when you break it down, how many cuts do we see left in the cycle? I think that really gets down to the crux of it. Where should the 2-year be? Where should the 10-year be? Where should a normalized yield curve be? You can work backwards from all that. And I think the primary driver of that is what is the market's view of how many Fed cuts we have. And so you have SEP's statements that like through 2026, we're going to have, there's a lot of divergence within the SEP. So I think I take a little bit off of that right now, but the SEPs are more like 4 cuts between now and the end of 2026. And then you have the SOFR curve that's like more like 6 or 7 cuts. So what we see is when we have 6 or 7 cuts remaining, the 10-year is in a cycle. The 10-year, it's kind of appropriate for the 10-year to trade close to where the Fed funds rate is. And it's appropriate for the 2-year to be maybe 25, 30 basis points below the Fed funds rate. And so I think, and it's appropriate for the yield curve to be a little less steep than normal. So the yield curve maybe is more like 40, 45 basis points. So you say like from that back to the envelope math, we think that in 2 years, it's appropriate for the 2-year to be like around, call it 4 or 3.95. Maybe it's a little overvalued here. And then the 10-year could be somewhere around 4.4 right here. And I think that's about fair value for the 10-year, given what we see from the Fed. So I heard so many really crazy predictions about the bond market coming into the year, like 5.5%, 6% on the 10-year, like this year from many commentators. And I just thought, well, I don't see a world where where the Fed is, the SOFR curve is implying, for instance, 6, 7, 8 more cuts in this cycle out through say 26, 27, and the 10 years the yield's just going to take off. Like it would be a crisis in the bond market that like we haven't seen, to have the bond market divorced from the Fed in that way. And so we said that's not really possible. So the bond bear scenario is that if the data comes in hot, which causes the market to start to reckon with the idea that the neutral rate is higher and the Fed's not going to be able to cut, then the whole curve has to shift around in a really nasty bearish way. I don't think we're there yet. Like one day we will have that problem, but I don't think we're there yet. That's why we can look at the curve and we can look at what the SOFR market and the Fed is saying for cuts, and we can take that at face value and then back into fair value. But what really moves the bond market is the data. So you need to have a view on the data, how the data is going to come in. If the data comes in weak, growth-wise, labor market, you're going to see more cuts come in to the SOFR curve, just like we did last year, which is then going to cause yields across the curve. You're going to get a recessionary bent, yield curve flattens, stuff like that. If the data came in hot, like we were just growing jobs magically now and reaccelerating, then, the bond market starts to question. Maybe the neutral rate is more like 4% on the Fed funds rate. And that means like once we're done cutting that the yield curve should be more like 2s, 10s should be more like 100 basis points. And that means that the 2 year should be, the 2 year should be more like 4.25 or something like that. And the 10 year should be more like 5.25. Like that's what we would need to get to those predictions. A full reversal of all these cuts that are baked into the market right now. It would take a lot of hot data that's against what we see to get to drive us there.
I know coming into the year, your call was 100 basis points of cuts. You just did your second half outlook and you revised that to 75 basis points of cuts, largely because you think that this sort of mini rebellion from the Fed is going to slow them down.
Yeah, I mean, our view was for, like I said, up as this all stuff fits together, is that we thought we'd come into the year, Trump would take office, there would be some growth starting to slow, but the Fed wouldn't cut. We called it a recalcitrant Fed. And the reason the Fed wouldn't cut is because the tariff policy, the Trump policy, a little bit of a rebellion against what Trump was doing. And we kind of expected more of like we underestimated. What did we get most wrong in our outlook was the aggressiveness and haphazardness of the tariff policy that was imposed or proposed by Trump on Liberation Day. We thought they'd come out like a 10% across the board tariff. The Fed would still him and haw about what does this mean for inflation. We just went through a period of inflation. They get behind the curve a little bit. The market sells off. We have 10, 15% correction until the Fed relents and says, okay, we have to cut now. And we cut 100 basis points in the, say, around May forward. That was like how we saw the year going. I think everything just kind of got exacerbated. And honestly, Trump's way of proposing his the Liberation Day raids on tariffs and stuff like that in such a crazy way has given the Fed cover to be like this. Because they're like, this is destabilizing. Like, and of course, I don't think tariffs are really truly inflationary. I think that tariffs are actually deflationary. It's a tax. And when you look right through it, it's going to, like we talked about, it's going to close the deficit somewhat if we generate revenue, and ultimately will hit demand, aggregate demand. So I think as you go through this one-time pop, you come back down the other side. So it's truly transitory price inflation on the tariff side. But way Trump did this is like, it opens the door to all kinds of crazy stuff. Like the norms get upset. They worry about retaliatory tariffs in the trade war. And that's all real. We're talking about embargo level tariffs. So he gave the Fed cover to become what we called recalcitrant, like truly, really recalcitrant, with maybe even some good reason and logic there. Now Trump's mad they're not cutting. Well, I mean, Powell just came out this week and said the reason they're not cutting is because of the tariffs. It's all kind of distilled into that. And so I think it's still exactly what we saw, just a very cartoonish version of what we saw coming into the year, starting with the way the tariff policy was designed. And so as you look through that, I do think the data is weakening. I think the housing market's weakening. I think the labor market's weakening. And the Fed is going to begin. They even as much as they're a little political and recalcitrant and they're pushing back against Trump right now, they still don't want Powell still doesn't want to usher in a recession. And I think that, you can even see it now. I think that's why the market's starting to break. Yeah, they see a dovish new Fed chairman coming next year and things like that. That's part of what's in the market. But the market, even for 2025, is putting new cuts in. That's during Powell's term. They're saying, okay, the data's starting to cool. Powell's starting to realize he's got to do this. So we're getting back on track. We think we'll get 3 cuts before this year's over out of the Fed. And, how that feeds into the bond market is, like I said, we think that the 2-year fair value is like about, we call it 3.95, and 10 years at 4.4. The yield curve was all abnormal and inverted coming through the initial set of cuts. It bear steepened, and it's back into a normal posture. So we would expect these coming cuts to have more of a normal effect on the yield curve, on the bond market in general. And so that's kind of our view. And so that's how does that translate to equities is that as long as there's no real, like going back to the debasement idea that this is where the bond market is our big concern for equity investments. Um, we don't see a scary bond sell off coming this year. And the risk still, as we go through just this year, 2025, is more skewed towards a growth shock and a malaise that impacts and maybe even policy induced malaise that ends up uh, causing us to flirt with the recession.
So when you say a growth shock, where do you think that's going to show up? You mentioned weakness in housing. We just had the chair of the FHFA today come out and say that Congress needs to investigate Jerome Powell for his recent testimony. I mean, making some serious claims. Where is housing weakening? Because you do have some charts that seem to indicate that things aren't too bad. I mean, I'm looking at this home builder margin chart. Home builders seem to be doing okay. I mean, the stocks have sold off over the year, just had a huge rally this past, couple of weeks.
Our view, you have to have a view. If you're going to call, like, but what was recession coming? You have to have like a model. How would a recession start? And, it could change. I heard your colleague Jack with a really interesting conversation that healthcare has become such a big part of the economy that maybe we could have a recession start in healthcare. That's interesting and worth thinking about. But for now, our basic mental model is that if we're going to get a recession in this U.S. economy, it's going to have to start from these rate sensitive areas, and most specifically housing. Housing's got a big multiplier into the economy. I know fixed residential investment is a small amount of the economy, and that's the pushback. But there is a multiplier. You get a durable goods cycle that comes with your housing cycle, and there's a lot of stuff downstream from housing activity. So our view is that that's how it starts. If you look at history, the the tip the residential construction payrolls, very small sliver of U.S. payrolls, is the best leading group of payrolls going into each modern American recession. It's like an 8 to 10% drawdown on revised data, which is important when you're doing your analysis, that that you see a drawdown here before you enter a recession. So the really simple, there's a lot of stuff, and we bake a lot of stuff into our models of the housing market. But when you really just say, make it simple, is that if we're going into recession, we should expect to see these construction layoffs lead broader layoffs in the economy. That's the pattern of history. Builder margins, we talk about that because that does elongate this cycle. Builders have a huge, new housing has been the only thing moving. They've been able to buy down rates, incentivize. That margin is just room for more incentives out of the group. So with the immigration policies being what they are, and already a secularly tight labor market, there is going to be labor hoarding. So, our view is that you're going to see layoffs in this segment before you see it in the broad economy, and we haven't seen it yet. Our models say there's a lot of overcapacity right now, given the amount of activity, units under construction, housing starts, backlog of work, all that stuff, that there's you should have residential construction payrolls about 12% lower than where they're at right now. They're at like 960,000 employees. That should be like 100,000 less according to our models, but they're not there. And they've been over capacity for a while. And why is that? Our best guess is because of the labor hoarding, because of the immigration dynamics, because most importantly of new home builder margins. They don't have that stress to lay people off. And they know that on a more long-term basis, the country is kind of short housing supply. And so why fire a bunch of employees that you're just going to have to hire back as soon as the cycle turns around? So they're going to hold on to those employees to the bitter end. Does that change the cycle? Is a good question, but our view is still that that's where it will start. We're going to keep modeling it out and looking for stress there. Like I said, those payrolls are still at cycle highs. We are not going to anticipate a leading indicator. That's what we tell our clients all the time. It's a leading indicator. It should give us enough lead time. And so we would wait to see at least a couple, 2 or 3 months of consecutive job losses out of residential construction payrolls before we started to get like really worried about a recession. I think growth's here. All that data is going to look kind of soft. Job growth's pretty not pretty lukewarm at the very best right now. Hiring rates are horrible. And so what that means is that, though, is that we're going to have a growth scare, not a recession. I think it's just giving us the Fed the green light to cut and ultimately sticks us back in this kind of soft landing scenario that we've been in since 2023, 4, really.
When I hear elevated margins, probably labor hoarding, potentially weighing on those margins, and then also seeing, units under construction making lows, what do you think about the home builders moving forward? Do you think they're going to make it to the other side to these cuts that are going to, definitely stimulate housing demand?
I don't think there's a ton of downside. My view is there's probably not a ton of downside left in the builders as an equity group, but they got beaten up pretty badly. If our view on rates is right, then builders should do okay. I think it's a very interest rate sensitive group, and that's what you need in order to get that group moving. And just like we've seen, we saw rates come down a little bit, and the builders have a little pop. More than likely, I think rates for a little bit here until the data starts getting a little nastier are going to stay more in this range bound trading. But I don't see a ton of downside. Builders not running out to buy them today or anything either. But I definitely don't. There's not a lot of stress. I mean, balance sheets are strong, margins are strong. This industry is it's not 2008. It's nothing like that. There's a lot of fear mongering and stuff like that. We've pushed back against that for years. It's like going into 2022 when the builders got sold off. That was one of our big recommendations to clients. We pounded the table on buying builders there and home builders. And I remember posting that on Twitter, and like it was just like proverbial tomatoes being thrown at me by everybody who was, because their memory was '08, and that was what they were keen off of. And I knew it was a good trade with the amount of pushback that we got there. It was pretty nasty.
Well, let's shift to the equity market. We've mostly been talking about the economy, and because I think you are rather bullish on the economy, it sounds like we've actually spent a lot of time talking about risks. Despite that, you're pretty bullish on equities.
You can get so down rabbit holes when you're doing research and stuff. Like I like to have little rules of thumb that I try to live by, that I don't get too um, out of lost or out of my away from my principles. But like if you don't see a recession in your models and you don't have Fed tightening, then I don't think you should be underweight equities, especially not in this world where we have what we call a debasement mindset. And I think that does benefit, broadly speaking, equities. And so we are overweight equities at the moment in our recommendation and have been for a bit. But I I I think we'll sit there until we start seeing cracks in either of those two areas. And I don't expect us to see that. Um, the the risks to the downside are well known. A lot of people wonder about the upside. And I don't think you necessarily need I don't know if a bull market needs like a upside catalyst. It's ideal to have one, but it doesn't need one. You just need momentum and the lack of anything bad happening. And I think equities drift higher in general. But in this case, I think there is a pretty powerful upside story to talk about. And it's the AI story, something we've started to highlight. Um, the Census Bureau does a biweekly survey of firms, and the AI adoption rates are really ramping. It's not my area. I had Fernando. Fernando's my research partner, and he is, his background is machine learning. His degrees in machine learning, what I would call an AI expert. We've had him on calls with some very high level AI people. And I just don't see anyone who's seen around corners there better than him. And he put together an estimate of token generation and token growth for the LLMs going forward. And we see kind of like an S curve ramp in token generation. Let's say we're at, I think if I remember correctly, it was 50 trillion tokens generated a day today. And we could have that 4Xing between now and next year. So I think the bottom line is you have this potentially, I think it is revolutionary technology that's starting to come forward, and it's going to take hold first in large cap equities, and that's where you're going to see a lot of potential productivity gains show up first, and that is what I'm describing again is like kind of the S&P 500. And so I'm not saying, yeah, you could buy Mag 7, yeah, you could buy the AI names and the tech names associated with data centers. I mean, that's been working, but I think the next trade is really more of these high quality S&P 500 companies um, that can use AI to push out their margins. And we've done a lot of valuation work on the relationship between margins and multiples. And this was going back, we made the case the S&P 500 is not really overvalued. I think that's a consensus view. The S&P is overvalued here. And we've done a lot of work on that. And really the strong, the bottom line, why we see that is because when you dig into what happens with margin expansion in less cyclical businesses, which that's describing really the whole of the S&P 500 at this point. We can get into that research, but that that is a recipe for higher multiples. So I think that we think that we're basically fair value. Let's say a lot of people say, "Oh, S&P needs to be at like 16 times earnings because that's the long-term average." And we're just not going to get there again, at least not anytime soon. And if you really do something beyond just like lazy historic PE analysis, you can see it pretty easily, I think. And so the bottom line is if we can push margins up, it gives us a multiple expansion story. Even in the next year, as the AI adoption rate takes place, the adoption story takes hold. And sometimes, just to be a little cynical, but also honest with everybody who's out there, sometimes you don't really need the story to take a full hold. All you need is for investors to believe it a little bit. So if you have one or two companies just come out and make the suggestion that make the announcement that they're not going to, their hiring trajectory is going to change because of AI, those stocks pop, it feeds into the other stocks adjacent to them. And it's like a ripple that goes through the market, whether it's going to happen or not, and what the degree will be. And I think the job of investors, at least on a cyclical time horizon, is to be ahead of that, not to be behind that. And so I see that out there in front of us, and I think that's also working to exert an upward force on equities outside of just momentum and the lack of a real scary risk um, to push us lower.
Those names that you're talking about, the mega cap tech names that people I think have identified as probably the big AI productivity winners, that has been what is leading the market higher. So do you think the market is already aware of this, or is this just the general trend of the top of the market leading us higher? Because that's not a new thing. That's been happening, since the beginning of AI before it was really starting to be priced into the broader market.
I mean, it's the easiest way to get that direct ownership of the AI theme. It's like we've spent a lot of time with a lot of clients, and like Fernando will get on calls with them, and like ultimately the roads lead back to the same companies. If you want AI exposure in your portfolio, and everybody that's a generalist does, and so yeah, I think it is a signal. It does raise the kind of ancillary concern. We ran through a whole bunch of technicals that were very positive in our second half outlook. The kind of one fly in the ointment is the breadth of the market continues to look kind of nasty as we've made these new all-time highs. So we measure like the median stocks distance from a 52-week high. That chart has gone down as the S&P has gone up. So meaning that the median stock is farther and farther away from a new 52-week high, while the S&P 500 is making a new high. And if you break all that, we break it down, like, does that really matter? How abnormal is it that the median stock, like, at least when we wrote our outlook report back on June 26th, it was 13+% away from a new 52-week high, the median stock. And that is way abnormal. Or when the S&P, if you put a histogram of when the S&P hits all-time highs. And so we asked the question, does that impact forward returns? And it does. It's generally lower forward returns when the S&P makes a new all-time high on bad breadth like that. we're not going to overreact to that because of exactly what you said, which is that this is a pattern from really 2023 on, where mega caps, the biggest stocks are leading the market. And that, by definition, if that's your leadership group, you're going to be always making new highs on bad breath. And so you remember, we've done this study in many different ways because it crops up in a little bit. It looks a little different each time. It cropped up in mid 2023. We call that a mega cap divergence, where the top 10 stocks make a huge run and the bottom 490 don't come along. And we looked at what that means. It happened when we made a new high in January, February of 2024. It happened again later in 2024 and middle of 2024. We had a little bit of turbulence in the market. And then it happened again at the beginning of this year. And I think it was actually an interesting signal. Then it was part of the reason we downgraded stocks in February for a bit. But I think that the default in our analysis is that what's going to happen is the rest of those S&P 500 stocks are going to join the S&P, the mega caps. And, our view is that if one easy way to track this is you watch the S&P 500, if it makes a new all-time high, in general, the market's is going to do well and perform as you would expect following a new all-time high, as long as the S&P equal weight goes on to confirm that new high within 3 months. So made a new all-time high at the end of June. By the end of September or so, you need to see the S&P equal weight confirm. It was like 4% below an all-time high when the S&P broke out. And that's a good that's a good rough proxy for breadth, that relationship. And I would expect that. That's what we're betting on, is that we broaden out, because the AI adoption story and the AI benefits are also going to broaden out beyond just that narrow sliver of stock.
So we've talked about the fundamentals. You believe margins are going to improve, that there is the potential for this AI productivity boom. Beyond AI productivity, are other fundamentals looking strong?
Earnings, estimates came down, but not in a way that was really concerning. Like, that kind of happens in the beginning of the year. You lower estimates and then jump over a lower bar. It's just typical S&P 500 behavior. And so I think that the coming through that Liberation Day stuff, you saw estimates get pulled down a decent amount. But I think at the end of it, when we get through that these companies are going to clear that bar pretty easily. So I think fundamentals look okay. Another thing we looked at is forward earnings are now at an all-time high for the S&P 500. And just real simply, look at performance in the S&P 500 when forward EPS is at an all-time high versus when it's in a drawdown of any kind. And it's a huge difference. And so it's a positive thing. You're seeing the forward outlook going up. And the fact is, I think now, I don't know where we're at today. Right now, we're probably 62.50 or something on the S&P 500, something where the multiple might be back to stabilize. But when we got through the middle of the year, S&P down flat for 6-7 months, earnings continue to creep higher, make new all-time highs. That's a consolidation. When you zoom out on a chart, that's what a consolidation looks like. And it resets sentiment. It gets people off sides. We saw the sentiment reset that we wanted really come through. I mean, strategists went from their targets for about 6,700 on the S&P 500 entering this year, which looked very much like a market top, and now back to 6,000. And so strategist targets below spot S&P 500. You can test that as a signal. It's much better to own the S&P 500 when the strategists are pessimistic like that than when they're optimistic like they were coming into the year. So to me, earnings going up, price flatlining, strategists coming back, sets us up well for H2.
Now, what about some of the other seasonality type of indicators that you looked at? I mean, it was the first year of Trump's presidency. Obviously, we got a ton of policy-induced volatility in the first half, but volatility in the first half of a first-year presidency is the norm. At least that's what your research shows.
Yeah, I mean, we called it a cartoonish version of a presidential election cycle. And that's, we talked about it. Again, this was like, we thought coming into the year that this was like an okay script for us, that Trump takes office. There was so much optimism off the election. And there was this phrase, if you remember back then, it was like, buy the election, sell the inauguration. And then people started getting cute, like, buy the election, sell the inauguration, and then a couple weeks, because they wanted, just like always, you overstay your welcome. And so we thought that's kind of what the rough outline of your first year of a presidential election, new administration shows. You get this inauguration, and then you get a dip, volatility through the spring, and then a rally. I don't put, it's a good roadmap, and I think it's good to understand those things. There's so few cases to study through history, and every historical period is different. So I didn't put a ton of weight on that, but it's still you're looking for things to kind of set a framework that makes sense to you. And that did make some sense. And then the way it's played out, though, has been just extreme on all sides. And if you just looked at the way the typical year ends in the first year presidential, it's actually pretty positive. And then on the other side, July seasonality is, everyone knows this by now, I think, but July is first half of July. If you broke the year into 24 different buckets, first half of July is really positive. So not ready to back off on our equity overweight, even on a tactical basis right yet. And then the question we had that we haven't shown this to clients yet, not this groundbreaking research, but it's just like, what about if you have a really strong May and June? Is that July seasonality hold? Is actually stronger? And I think you do get these inflows in July. If anyone's missed the party, they have to put cash to work. It's a big time mid-year to put cash to work. And so we still think if you're going to see some weakness in the equity market, we're looking out more towards like that August, September, maybe even into October period. But I think the Fed's cutting by September. Who knows what's going to happen between then. And the tariff thing's obviously a worry. So we could be I would love to get everybody back on sides, then dial down our equity weight, let it get a little more of a shakeout, a mini shakeout, and then get back in. But that's kind of getting too cute to plan all that out. For right now, we just trust our indicators. We're still overweight at this very moment. And
Okay.
that's what we'll ride.
All right. So 6,800 S&P 500, 3 cuts. Any other big calls for the year?
I think the 10-year trends lower. That would be like a big call. I think oil trends lower. My predictions coming into the year were that we had S&P 6,800 as our year-end target coming into the year. We had a first half correction of more than 10% coming into the year. We had the 10-year at the average 4% for the year, which was too aggressive, but directionally correct. We think it's probably more like 4.1 through the second half of this year. We said that oil would break below 60 at some point this year, and that has happened. I still think oil's got more downside than upside as we come through the rest of the OPEC supply increases, and probably wringing out all the last few drops of that geopolitical risk premium and reset the futures market. So those are the big, and I think gold is going to go back. We had gold at 3,000 coming into the year. I think we can move that target up to 3,500 pretty easily in this quote unquote debasement world that we're all living in. Gold's kind of like all roads lead to gold. So those were our big picture predictions and where they stand, right, wrong, whatever. We'll mark the market at the end of the year again and see how stupid we look.
All right. Well, so far so good. And look, it is a big anniversary for you, not on the research side, but on your other business, the investment management business. We had you on to talk about the launch of the full cycle trend ETF and your move from pure research to launching this other business. We sit here 1 year away. How does it feel looking back on this first year as a manager?
It's been really nice. It's what I would call a blessing and for us. And we've been very fortunate to have clients and partners who believe in us, who want to work with us and want to run money off our models. We launched the RAA ETF, which is based off our real asset allocation model, which was like the original model we came out with when we started this firm and talking about this debasement mindset and all that stuff. And it's like a structured way to bring alternatives into your portfolio. We cycle through 20 different assets. That thing, we launched it on February 26th. And so we launched it really close to the market top. It was a, you know, yeah, kind of a wild environment. And in that short period of time, we've got something like 440 million in it already. And so I just feel really, honestly, I just want to do a good job for our investors. That's how I feel. I feel like a sense of responsibility. FCTE is, again, it's a 20 stock selection system. It's a factor. We set it and forget it. It's a model we built, and it looked for quality stocks with certain trend characteristics. It had a rough Q2, really just a rough June. It was doing okay year to date, and then fell apart in June. And so that's part of what we do, though, is like we want to be very transparent about our performance and how we analyze what we're doing, and always just be, looking at what is the foundation here? What are you doing? And the research is the foundation. Markets are going to move up. They're going to move down. Some days you're going to look like a genius. Some days you're going to look like an idiot. But, I think the thing that drives us, and I think that also keeps our people investing in these products, is that they believe that we're doing good research underneath the surface as we develop these models and then let them loose into the wild. So it's like, I think we have something like 865 million in the two funds now. And for every single person who's entrusted us with anything, just, I'm invested with you. And we eat our own cooking, and we just are, very grateful for it all. And I still love research. We have all this stuff here is like our discretionary calls, our discretionary research, what we think is happening in the world. These are all model-based, quant-based models that we developed many years ago. They've been running with track records in real time for years. And that's the difference in the business, just so everyone's pretty clear on it. But yeah,
Yeah.
I would say just the year anniversary, more than anything, is just a really strong feeling of gratitude and, happiness.
At different points when you first launched FCTE, you took a big lead on the S&P 500, lost it towards the back half of 2024, or really the end of 2024, got back out ahead actually a couple times earlier in this year, and now I believe at the 1-year mark, behind about 4%. I'm interested to hear what it's like talking with clients at those different periods of time, what flows are like at those different periods of time, and how anybody who's, especially somebody who's doing a long only product that's trying to beat a benchmark, what it's like at those different periods.
Yeah, I mean, we're offering a certain exposure. Like, it'd be easy, and not easy, but like easier to just kind of do something that's really tracks the S&P as conservative. There's so much stuff out there like that. Our goal is to give you an exposure, to do the research and give you exposure to this portfolio. It's a concentrated portfolio. It's 20 stocks. They're equally weighted. We're only looking at quality names to begin with, and then we're drilling down to only 20 names. We turn that portfolio over maybe 3.5 times a year. And so that lends itself to volatility against the benchmark. Like you said, we were up double digits within Q1, and then gave it back and then up. That's abnormal if you look at the back test of the strategy and even the real time performance of the model. However, that's what we are providing clients. Clients don't come to you. I don't think I would be able to take the fees if I thought what we're doing here is just, you know, minor ticks and tilts against the S&P 500. This model is one of the big benefits, in my opinion. It's equal weighted, 20 stocks quality. It's like you're afraid of over owning a Mag 7, for instance. You want to own quality. You don't want to own, like, the S&P equal weight is very value oriented. And that's a whole nother, you know, it, pile of ants. But so what are you doing? We're providing a very specific exposure, quality, equal weighted, condensed portfolio. And like I said, I think, the performance comes and goes with the research. I mean, you can check out our white paper on our site. You can, if you are interested in finding out more about the model, we can send you the the picks and the performance all the way back to 2021 when we launched the model. You can see how it has performed since 21, 22, 23, 24. Sometimes it underperforms, sometimes it outperforms, but when you zoom out, it does well. And that's what we're betting on. I think that's why we haven't had big outflows. We haven't had clients or investors say, "Oh, we're giving up here yet." So I think that really is during bad times, good times, those are always easier conversations. Everybody's happy, but during the bad times, I think that's the ones you remember the most. And like, we've laid the foundation, I think, in a way that, we have the right partners and clients with us. And that's what I think really matters in this business. So
So
we'll see. No guarantees, but I mean, we will continue to add that to provide that exposure that our research suggests is additive and diversifying for equity managers.
on the real asset allocation side, it's very different. That's more cross asset in what you're looking at. What is the difference in terms of the clients who are interested in the RIA versus the FCTE?
I think FCT is a satellite strategy. So we're trying to get onboarded with a major asset manager who's a client who wants to invest a sum of money. And that would be, they look at that as like, this is going to add spice to me, it's going to add exposure, like I said, that they can test and look at that stream of returns and add that into their overall portfolio and help them in certain market environments, especially late cycle market environments. The RAA is more of a core. So it's probably a different clientele. The FCT is a satellite for big equity managers. RAA is a core for if you just have money that you want to throw aside that's, diversified, tactical, can expose you to 20 different asset sleeves from domestic equities, foreign equities, high yield, investment grade bonds, TIPS, T-bills, treasury, longer term treasuries. And then in the alternatives buckets, we have Bitcoin and managed futures and gold. We break mining. We have commodities, but we also break commodity equities out into metals miners and energy stocks. And we put that in the alternatives. We also, within the energy sleeve, we take our own research and only buy what we consider the quality energy companies. So we have a 10 stock energy sector. So you're not buying all the junk within the energy sector, which I think is again, if you could find the best factor within energy for years, which I think will continue as we kind of get into the twilight of oil, is this quality factor. And so it's an all encompassing asset allocation program. We rebalance it monthly. It's tactically shifted based on trend and volatility. And it's just a great core holding. If you're an advisor or if you're an investor and that's what you're looking to accomplish, you don't know how to do it all yourself and you want to keep the taxes. It's for the trading costs and taxes in the fund. We do all that. The ETF's great for that. Rebalance, like I said, monthly, and we save we do our best to negate all the capital gains within the fund. And so it's a totally different product. Again, the one similarity is these are both completely quantitative systems that we've run for years for our clients. And there's a white paper on the RAA, the real asset model, that we put on the 314 website, which you can check out as well if you're interested in learning more about all the kind of nerdy details that go into it, all the research.
Okay, so obviously a lot of big things came out in the last 12 months. Anything new coming up, or is it more focus on what we've just launched, try and deliver?
Well, we definitely want to keep focusing and delivering. My biggest goal is to just continue to provide insights. Like we, trying to stay in tune with the markets, look at them have a flexible mindset, but also be data driven at the same time. And if you do that, my experience, like we talked about before, good things are going to happen for you. Whether it's your investing returns, whether it's your calls, whether it's your research, whether it's your partnerships, whatever it is, things are going to happen for you. And so that's the straw that stirs the drink, as I say, for us. And that's where I'm going to focus. Like I said, we have other potential things that could happen down the road, but the timing has to be right. Capacity has to be right. And, we kind of are a methodical and slow moving type of little company here. So right now it's just focus on the research and let all the good things flow from that.
No discretionary hedge fund?
I mean, there's discussions for that. Like I said, we have a specific client we've had discussions about that. And I'm kind of letting them lead the dance on timing for that, because there's a whole bunch of stuff that they have to line up. So,
It's a lot of startup costs.
yeah, but I mean, that wouldn't be my part. We would be more of the research arm. They have a trading group already. These are well-known people too. And so it's people that we've worked with and I know for years, and we have a good relationship. So if it happens, people will recognize everyone who's involved, and they're legit. And so it would be a fun thing to do. One day, I would imagine it's going to happen. It's just a matter of, will it be the next 12 months? I don't know.
All right. Well, Warren, you mentioned the 314 website. Where else can people find you?
314 website is, like you said, you can find the 2 white papers for the models that are underlying those ETFs. And then on X, at Warren Pies is a good spot. And you can also follow 314. I think it's at 3F_research on X. We'll occasionally send out like the front page of our research reports or podcasts or CNBC interviews and stuff like that. So you can get a pretty good idea of how we feel about the markets just from following us there.
All right. Well, Warren, thank you so much. Thank you to everyone for listening. If you're watching us on YouTube, please like, share, subscribe. If you're listening, please leave us a review on Apple Podcasts or Spotify. If you're listening on Jack's Monetary Matters feed, please check us out at Other People's Money with Max Weethy. Getting more likes, reviews, and subscribes there is hugely helpful to me and my show. So, Warren, thank you so much.
Thanks for having me, Max.
Thanks for tuning in. Looking into SMH or SMHX? Head to vaneck.com/SMHmax and vaneck.com/SMHXmax to learn more.